If you're thinking that the only path to retirement is working harder, saving more, and investing in the stock market till you hit 65, I invite you to the 10x Your Financial Freedom Through Real Estate free virtual experience in September. I'm going to be going over my proven framework that I used to get to financial freedom at 41 in a few short years while working full-time and raising young kids. And I know that you can do it even in the current market with interest rates the way they are, and even through a recession, because hundreds of our students, many of whom are busy physicians just like you, have used the same time-tested strategies to acquire over $200 million of real estate. And on day 2 of the event, you get to meet some of them and hear their stories, how they got to 6 figures in passive income while saving hundreds of thousands of dollars in taxes in this market. So if you're tired, burnt out, and ready to take back control of your time and income, if you're struggling with getting your first long-term, short-term rental, or investing in syndications and you don't want to learn from costly mistakes, or you feel like you don't have the time or money to get started, or if you're ready to go from a handful of rentals to 10xing your cash flow, we will be building your personalized recession-resilient real estate portfolio so you can accelerate financial freedom while paying less in taxes. So get ready to go from working harder to working smarter. Register for the event at generationalwealthmd.com/event in lowercase, and I'll see you soon. I'm excited about today's topic. It's about 5 tips to invest in real estate in 2024. And if you know me, the 5 tips is actually 5 big headings and then subheadings. So let's get started. 2024 has been a very tricky year. Everyone went from focusing on, predicting a recession to now predicting a soft landing. There's stock market volatility as we're recording this mid 2024. I've had investors reach out to us, it's causing some concern. And then there are talks of interest rate cuts coming pretty soon. And so I feel like if you're someone who's been on the sidelines with everything that's been going on, I want to go over 5 things that I absolutely think you should be doing to position yourself strongly to invest in real estate in this market and to take advantage of the opportunities that are coming our way the next 12 to 24 months.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param Balatandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
So we are going to be talking about strategy, what I want you to be hyper-focused on. We always talk about returns, right? What can you be doing this year and next year to make sure that you are boosting returns, right? That's how we accelerate to financial freedom. And yes, it's a buyer's market. It's very different from a seller's market, which we were in say, 2022. So what are we going to be doing in this market, and how can we minimize risk in our portfolio? And I think those are the big things that we have to look at. So I strongly believe that there is a unique window of opportunity right now for real estate investors who are willing to, move in and reap rewards before interest rates start dropping. Because as interest rates drop, competition is going to increase. Asset values are going to go up, right? So we want to get in ahead of that. So let's deep dive and talk about that. Now, most of you realize that with any strategy, right? It's never about the strategy. It's always about psychology first, right? First tip is, as you're thinking about investing, there's going to be a lot of talk on social media, in the media, among friends, right, about how the market is right now and whether this is a good time to invest. And so I'm going to give you 2 key points, right? So the first point is going to be about psychology. You really have to work on your psychology if you're considering investing in 2024 and 25, because this is the time to be counter-cyclical. It's like Warren Buffett says, right? Be fearful when others are greedy, and be greedy when others are fearful. And this is a time where others are fearful, and there will be a lot of clickbait and a lot of data that gets thrown out. And remember, data is only as good as the interpretation. So when you hear things, this is what I'm going to be doing all of this year and next. When in doubt, zoom out, right? Take a look at the data from a historic perspective, longer term data. That's going to be important. And having your emotions in the right space, the psychology, is going to be your first step. So under that, I have, like I said, 3 things that you're always going to pay attention to, right? One is going to be the economy. Know that the economy is sending us mixed signals right now. We are anticipating interest rate cuts. We are seeing GDP growth, which is all positive. You will be hearing about unemployment creeping up. If you paid attention to the state of the market we did recently, there's a small creep up, right, in terms of unemployment. Stock market volatility is there, but that is typical for any market that's seeing any kind of shifts, right? And the stock market tends to react with more volatility than the real estate market. I showed graphs last week to show you how that typically works. And so what you want to lean into is the fundamentals, the long-term fundamentals of multifamily as you think about investing, right? And those fundamentals are strong. We still are in a time where affordability, it's so much cheaper to rent than it is to buy a home, right? That's because of interest rates and home prices. We are in a place, the country as a whole is still in a supply-demand mismatch where it's going to take us another 5 to 10 years of large amounts of supply hitting the market for us to actually catch up over there, right? And although we will have oversupply in 2024, new constructions are going down. And so there's going to be this strong absorption right now. 2026, we're going to start seeing significant rent growth and occupancy. So lean into the long-term fundamentals of the multifamily market. In terms of market cycles, we are at the bottom of the real estate market cycle, which means we get discounted pricing and therefore our returns in the long term are going to be outsized. So as you're absorbing all of this, go back to those 2 key points, right? Be greedy when others are fearful and zoom out and take a look at the data. So we are in a buyer's market right now. We are not in a seller's market. When we are in a buyer's market, how do we invest, right? So we go back to the fundamentals of that. We do have a tight inventory in single family, which means that, it's not the best buyer's market out there in terms of getting discounts. And again, this is market specific, but in multifamily, we are seeing cap rate decompression, which just means that we are getting discounted properties, right? So stick to your criteria. This is a time where you want to stick to your numbers. If you have cash on cash numbers, if you have overall return metrics you want to hit as far as investing, this is the time to stick to your numbers. This is the time where you can negotiate discounts, right? So make sure you can negotiate discounts. In a seller's market, sometimes you're giving up some of those contingencies. This is the time to keep all your contingencies, right? And sometimes sellers are willing to cover part of closing costs. We've seen that in some transactions, right? So everything that's true for a buyer's market, that exists in the current market. So stick to your criteria, and it's a time to look for discounts and negotiate discounts. Okay, so that is tip number 1. Let's move on to the rest of them. Now, the second part of this is going to be about boosting returns, right? And we talk about boosting returns all the time. For those of you who haven't signed up for the 10x Your Financial Freedom event, this is where we talk strategy. We talk about how you shift strategy in different markets. So we have one coming up in September. Make sure you sign up, generationalwealthmd.com/event in lowercase. If you're thinking about starting, if you started, you have a few rentals, if you have 10, 15 units you're looking to scale, this works for all of you guys. But we will be talking about boosting returns. So how is boosting returns? How is that strategy for boosting returns going to be different in 2024? Let's move on to tip number 2. Remember that this is the last year for 60% bonus depreciation. Next year, where bonus depreciation is phasing out, we'll be going into a time frame where next year we'll have 40% bonus depreciation, and then it goes down to 20 before it phases out completely. So if you are looking to acquire, it's a good time to acquire, right? You acquire now, you can always bonus depreciate later. That's the strategy part, which is going to be very personalized. Some of you, if you or your spouse are going to qualify for real estate professional in 2025 or 2026, you can acquire now. You can still bonus depreciate in the future at the 60% rate, right? So remembering that bonus depreciation is phasing out, build that into your strategy, right? If you're acquiring short-term rentals and you want that to shelter your clinical income, this is a good year to acquire because you still have 60% bonus depreciation. If you acquire next year, you're only eligible for 40%, right? And so you're going to do the same amount of work and get less reward. So really tapping into bonus depreciation is going to be a goal for those of you who are looking to do that. Same thing for syndication investing. Our Houston deal right now, gwcapital.com/Houston in lowercase. Again, we're still tapping into 60% bonus depreciation. We're currently on a wait list over there. So if you've been exploring that and you've been on the fence, remember, bonus depreciation is phasing out. So work that into your strategy.
If you're a physician looking to grow meaningful passive income, Did you know that you can do that by investing in real estate without having to find properties, analyze complicated numbers, oversee construction, or deal with tenants? In 2020, after working 10 years as a radiologist, I realized that if I follow the traditional method of investing in the stock market, it would take me until my 60s to be able to retire. So I deep dove into real estate investing, and by the age of 41, I had 6 figures in passive income from my real estate portfolio that allowed me to cut down to a day a week in medicine to spend more time with my young family. I've since gone on to help over 15,000 other physicians learn about earning meaningful passive income through real estate investing. And here's the best part: even when you invest in real estate syndications passively, without getting involved in the day-to-day work, you still get to benefit from 2 to 3 times higher returns, including tax-free cash flow day one. So if you're done with working harder, taking more call, and living frugally, and are ready to put your money to work for you, book a call with our team at gwcapital.com. We are constantly underwriting and doing due diligence on multiple deals in strong markets, doing all the heavy lifting for you. And we present some of these deals only to members we have connected with previously. So if you are ready to seize the opportunities present in this market and get off the sidelines, book a call with our team at gwcapital.com so we can learn more about your goals, walk you through the process, and get you priority insider access to our better deals.
If you're thinking about short-term rentals and thinking, well, it's not the 2022 market, how am I still going to thrive by acquiring a short-term rental? That's what the 10X event is for. We have so many speakers who acquired short-term rentals. Dr. Kumar, one of our coaches who self-manages 9 short-term rentals, she's going to be there. We'll be talking strategy, so make sure you sign up for the event. It's generationalwealthmd.com/event in lowercase. So there are ways to strategize around it. You really want to optimize your short-term rental, your visibility, your pricing. All of those things are going to be key if you acquire short-term rentals in this market. But tip number 2 is about maximizing bonus depreciation, right? Now, tip number 3 is about, well, we're still in the returns bucket. When you're doing rehabs, right? When your goal is to value add and use rehabs to invest in and, to really force appreciation and build equity really fast, remember to be super, super conservative in this market as far as your numbers, because the last 2 months we've seen rent growth in many markets, but rents have dropped and even plateaued in some markets for the last 2 years. So you can't be as aggressive about what rent bumps you can expect after rehabs. In some of our units in multifamily, we're just doing turns, right? We're not going in and aggressively rehabbing. So when you are considering rehabs, be conservative in how much you can push rents, and also make sure you're running your ROI numbers. If I put in $50,000, am I getting at least a 15% ROI on the property by increasing rents annually, right? Am I getting a 15% bump in revenue because of the amount of capital that I'm putting in? So make sure you're running those numbers for your rehabs, because this is a time where pushing rents is not as easy as it used to be. So those were the 2 tips, tip number 2 and number 3, in terms of boosting returns. And I always say this: investing is never, when you're underwriting, it's never just about returns. It's about returns and then risk, right? How am I boosting returns? How am I lowering risk? So the next 2 points, tip number 4 and 5, are going to be about risk mitigation. Okay. And the first, so tip number 4, the first in the risk category is going to be, if you want to de-risk your portfolio as you're scaling in 2024 and 2025, education is going to be huge, right? You want to stay on top of data, but you also want to educate yourself. This is the time, if you're really looking to, how do I pick the right market? How do I run numbers? How do I come up with financing, right? Even if I have very little to invest, and if I feel like I don't have time, how do I shift strategy based on all of that? Asset protection, accounting, bookkeeping, taxes, strategizing around taxes, rehabs, short-term rentals, all of the strategies about boosting returns. Know it, and then pick and choose what makes sense for you. Educating yourself is going to be key. If you really want to tap into the opportunities in the next 2 years, this is the time to educate yourself. Join the event and download the guide if you're a passive investor. So tip number 4 was educate yourself. Tip number 5 again, is like a few things, but tip number 5 is risk mitigation in terms of due diligence, right? So this is how do you do due diligence to lower risk in your portfolio as you're investing in this environment, right? Now, the market cycle per se is de-risking you because we are at the bottom of the cycle. As interest rates go down, we're going to start going up into a different market cycle, right? So we're going to go back into recovery. We're currently in recession. So the market cycle is already de-risked for you, but the fundamentals of de-risking remain the same. You will be looking at strong markets. You're not going to look at more short-term, okay, how's supply? Supply is important, but I would always say zoom out. Look at longer-term migration trends for the market that you're in. What was population growth like over the last 10 years, 20 years? What was job growth like in the last 10 years, 20 years? What is industry diversification? How many employers do we have? So those fundamentals, right? As you assess markets, debt is going to be key, especially for those of you who are in the commercial space as far as lending is concerned. You really want to make sure, I know there is a lot of talk about how this may be the best time to get variable rate debt, but really, in a lot of the projects we're doing, we are sticking with fixed debt, eliminating that variable and almost being very conservative in how we take on debt. Longer term debt, in the Houston deal, it's we have underwritten for 6%. We're probably going to get 5.6%, but it's a 5 to 7 year loan term. So longer loan terms, fixed rate debt is de-risking your portfolio. So be intentional about it. If you are going with variable rate debt, make sure you have adequate reserves. You also, in this environment, want to have adequate cash reserves. You want to go into deals that have good cash flow, right? That's another way you're looking at your buffers, knowing that we're going from recession into recovery. You want to be very intentional about this. And it's a good time to continue to find those deals, more so than probably in the last year, right? Some of our students have been doing higher down payments just to be able to break even or get into the positive cash flow territory. But again, positive cash flow gives your portfolio a good buffer, right? The right kind of debt, having cash reserves and going into strong markets. Fundamentally, nothing has changed over there, but that's how you de-risk your portfolio. So there you have it, 5 tips for investing in 2024. The first thing is always going to be psychology. How are you going to build, how are you going to set your mind so you're using data and not emotions to make decisions? This is almost like whenever you have a stock market crash, that's the time to go and put your money in when the market's at the bottom. But psychologically, it's a very hard thing to do, right? So work on the psychology. How are you boosting returns? The way you look at bonus depreciation, the way you look at rehabs is going to shift in the current market cycle. Education and de-risking your portfolio, that fundamentally, it's the same core. But if you are looking to take advantage of the opportunities in 2024 and 2025, and this may be, one of the few opportunities our generation has to really go in and optimize our portfolios and really scale them. If you want to be able to tap into them, educating yourself is going to be key. So make sure you do that. Tap into the resources I've given you. And again, this is a time when, again, I want all of you to be counter-cyclical. It's a time when others are fearful, but when you educate yourself and you are data-driven, you will be able to take the steps you need to take to really make the most of the opportunities we have in the next few years. Okay, guys, drop your questions in the Q&A and I will make sure I get to all of it. Super excited to hear your feedback about this.